and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services as Strategic Treasurer, and Ben Poole, Writer at CTMfile. Welcome back, Paul and Ben, to another episode of the Open Treasury podcast.
Thank you, Push.
Yeah, thanks, Push, for having us again. Always enjoy the conversation for sure.
Likewise, thank you for taking the time to share your perspectives with us on topics that impact the world of corporate cash and treasury management. In today's edition, we shall discuss 4 topics, namely the new Citi GPS report that says that companies that foster treasury leadership achieve better financial results, business leaders back globalization despite supply chain disruptions, credit risk in trade, supply chain, and export finance steady amid global uncertainty. And finally, financial institutions scramble to streamline trade processes ahead of T+1 settlement cycle. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's begin today's discussion with the first story, which is about the latest Citi GPS report that says that companies that foster treasury leadership achieve better financial results. Based on Citi Treasury Diagnostics Global Benchmarking Service, Citi completed a comprehensive study of almost 350 corporate treasury practitioners from organizations that range from less than $2 billion to over $100 billion, representing a diverse set of industries and regions across the globe. Citi Global Perspectives and Solutions, or GPS, new study report titled Treasury Leadership Does It Matter highlights 3 key insights and findings, which are as follows. First, organizations that nurture treasury leadership enjoy better financial performance. Second, the attributes of high-performing treasuries. And third, leading treasuries deliver high performance through digitalization. Paul, what, according to you, are the key insights from the latest Citi GPS report that you think corporate treasury professionals can benefit most from?
Yeah, Push, there's a lot in this article to unpack. But, the main question here, I know there's 3 key questions, but the main question is does leadership matter when it comes to treasury? And it does. Yeah, this article, this survey that they did does a good job of unpacking what matters and how much it matters. And so I'll try to, address these key points as concise as I can. So I'll start with better financial performance. And there's no denying that having top leadership in the treasury arena has an impact on an organization's bottom line. Their results showed that looking at earnings to revenue ratio, so this is, an EBITDA, earnings to corporate revenue, that there's a significant improvement between bottom tier to top tier. So getting top tier leadership in there that can help organizations think through the strategic financial impacts that an organization faces. It's getting better systems, it's improving processes, it's providing visibility, it's forecasting, it's being a strategic partner. It's not just the old school blocking and tackling of treasury anymore. Treasury does matter. Capital management, I didn't mention that as well. These things matter to an organization, can have a definite impact on earnings. And this survey points that out, rightly so. The other thing that we see in here about attributes for high-performing treasuries I'd mentioned policies or processes, procedures. For larger organizations, they tend to focus on this more. For smaller organizations, it's largely ignored in many instances. I've been at an organization where there were missing policies, procedures, processes weren't documented. And we see this on the advisory side as something that's common for smaller organizations. And I have to tell you, large companies are not immune to it either, but they do a better job of putting those things in place. And sometimes they just need help either updating or getting processes, policies, procedures in place for a changing Treasury world. Things have changed. Treasury departments are doing more, and so sometimes it's because they haven't had the time to go back and add things in that need to be added in. And so we help people with that quite often. Other areas that are coming up besides just systems and technology are liquidity and working capital or capital management. So when you think about organizations that may be capital intensive, or they have a lot of receivables in play and payables, manufacturers or distribution companies, organizations that have a lot of current assets, current liabilities that they got to manage, and getting visibility and use of technology to help them do that, and to be able to understand the forecast and where their pain points might be for liquidity. Do they have the right credit facilities in place? Are they able to access capital when it's needed, especially around unexpected things that can pop up from time to time? So I think this is becoming more and more important for Treasury departments within organizations, and so having a team that understands these pieces is really important. Some of the other areas that this survey does a nice job of pointing out is around KPIs, or having measurements that Treasury departments can benchmark against. And there really wasn't something that was traditional on the Treasury side. You saw it within other business units and organizations, and KPIs are becoming more and more common within organizations. So I think a treasurer leader, as a treasurer or otherwise within the organization, from a Treasury side, being able to come in and help address gaps in your key performance indicators, the KPIs, I think it's important to be able to get those in there, and they need to be relevant. It's got to be something that helps drive strategy, meet goals that the organization has. So it's you don't want it to be something that's not informing at the proper level. It's not providing the right indication that senior management and the board needs to make decisions. So the KPIs have to be the right ones within the organization. The other thing that was interesting around the company size and the use of a treasury management system, when they looked at the smaller organizations, there was less usage of technology relative to a larger organization. So 2 billion and less, only about 40% of them were utilizing a treasury management workstation, a TMS or TMRS. And when you looked at 10 billion and above, it was 89%. That's a big difference. That's 50% difference. I find that to be significant. And some of it has to do with getting the right technology in place. Some organizations may not be focused on what they need to be focused on, and having a good treasury leader in place can help them think through those things and find the right option for them to get a TMS that fits them. And there's many providers out there, whether it's a tech provider or your banking partner. They have platforms that they can utilize to get what they need in terms of visibility, cash positioning, and managing the liquidity for the firm. So there's options for them, and some of it may be just that they don't have the right leader in place to help them think through that. Some of the smaller organizations, I think, have some catch up to do on the tech side. Then when we think about one of the things that this points out as well is just the digital adoption. It's on the rise for large companies. Smaller companies, it's not quite as significant. And so I think there's just a disparage around the adoption rates that we see in play. And again, I think when it comes to leadership within the Treasury organization at a company, I think you need to have strong leaders in place that not only have knowledge and background, but just have the ability to get the organization, teach them, help them understand why they need to do some of the things they need to do to make Treasury more effective and how that will impact the bottom line. And this survey, I think, would be a great tool for treasurers, Treasury leaders at smaller organizations to utilize and leverage to show their leadership, hey, here's the rationale as to why we need to do this. And here's the impacts this can have. And it can impact our bottom line and provide us better earnings. I think when senior managers and boards see this, that will help drive the message that we need to make investments in these areas and we need to make sure we have the right people in place so that we can make the updates that we need to make and get our Treasury organization in a better position. So I think really good survey, a lot of information in there. I didn't go too deep. I'm sure you got some additional comments, but this was a really, really good survey for our listeners and our readers out on CTMfile. If you haven't looked at this, you need to get out and take a look at it.
Yeah, I completely agree with you, Paul. The kind of the breadth of data that's in this report is really fascinating in terms of all the different facets of Treasury that it covers. I think one of the key points that it pulls out that you described there is around how leading Treasury departments are pursuing digitalization, and obviously that isn't just getting the tech in. That's actually thinking, what can we do with this technology? How do we think about our processes and our policies with this technology? How do we get a digital mindset to make sure that we're capturing the efficiencies that this technology can actually give us? Investments in digital technologies let treasurers automate a huge variety of manual and time-consuming processes, which can free up a huge amount of time that can then be deployed more strategically. And obviously feeding into that are elements around how digitalization can enhance risk management, as well as you said, Paul, support insights to help the overall business growth and contribute to financial performance and improve that. So yeah, I think not much of a surprise, particularly when you think about the stat that, the top Treasury performance and company profitability are correlated in this research. So it's really, I think there's a lot of food for thought for treasurers, wherever you are on the spectrum of how advanced you are, or if you're just starting on a digitalization journey, there's an awful lot to get your teeth into. So I'd absolutely agree with getting a look at that report and seeing how it might apply to your processes and policies.
Yeah, certainly after reading this, if they didn't understand on the front end, they're going to understand after they get done. The correlation is there and it's meaningful, so significant. They need to read this article. They need to get through that and understand what those aspects are and how those impacts can make a difference to their organization. If I'm a small business owner, or I'm a leader of a small business, public or private, doesn't matter. This has value. I'm going to put resources, whether it's people and capital or both, to get things up to date. This article will help drive that.
Paul and Ben, thank you so much for your excellent analysis. Moving forward to our second story for today, which revolves around business leaders backing globalization despite supply chain disruptions. Despite concerns over globalization, 88% of business leaders agree it is succeeding across 5 underlying pillars of trade: capital, technology, talent, and sustainability. This is according to research by Standard Chartered in partnership with Bloomberg Media Studios, published in the white paper Resetting Globalization: Catalysts for Change. The research surveyed business leaders across 20 markets in Africa, Asia, Europe, the Middle East, and North America to understand the drivers of globalization and assess overall sentiment. The global order, long characterized by the forces of globalization, now finds itself in a landscape dominated by geopolitical fragmentation and fragility and supply chain snarls. Ben, you covered this story for CTMfile. Can you please throw more light on this research, and why do you think business leaders will likely pursue a new model of globalization?
Thanks, Push. Yeah, like you say, it's a really interesting story because for a number of years now, globalization has been undercut by various factors. You know, if you go back 8 or 9 years, we saw a real outpouring of populist anti-globalization sentiment, particularly in a number of Western countries that came through in various election results. And of course, Brexit is kind of an outcome of that. We also then had various trade wars, notably the US and China, triggered at the time by former President Trump, and, you know, something that could well be resurfacing again down the line this year and next year. And then, of course, the pandemic, which shut so many global supply chains for a various amount of time and had a real impact on corporates around the world. And we've spoken previously on this podcast about how corporates have been adjusting their supply chains as a result of all this turmoil, looking to nearshoring or friendshoring, which, particularly in the case of the first of those, is making the world of the company's supply chain much smaller, you know, closer to home. So it's really interesting to hear a sort of pro-globalization sentiment against that backdrop. I think a major point of this report is almost globalization strikes back. But this time, you know, it's had a bit of a facelift. You know, it's trying to be fairer, more inclusive, more sustainable. In a press release that came out with the report, Bill Winters, Group Chief Exec at Standard Chartered, made the point that we need to enable a just transition to achieve our collective sustainability goals and ensure continued economic development. So the point he's making is kind of around the solutions to the challenges that everyone faces is to be found in collaboration and connection and not in fragmentation and isolation. And for me, I think that's a really fascinating reflection of the interesting times that we live in, because a decade or so ago, that point that Bill is making would pretty much be accepted as common sense. But today, it could possibly be seen as quite contentious in certain sectors of society. But I think the report shows that for businesses, at least, you know, this is the way forward, and the support for those 5 pillars that you mentioned, and high support, you know, big percentages, does show that the kind of the interconnected nature of particularly multinational corporates and how they view the world is on that global scale.
Yeah, Ben, you know, it was interesting in this, the first paragraph in this article, you know, 88% of business leaders agree, you know, is succeeding across 5 pillars: trade, capital, tech, talent, sustainability. And some of these, I would have to say, you know, depend on who they were surveying here. Some of these I think we're still way behind on. And I think there are challenges. We know that capital has been challenged recently with interest rate rises across, you know, various regions globally. Talent supply continues to be one of those things that I hear organizations. We were just at the AFP a couple weeks ago. We had a survey. One of the top 3 pain points that people were selecting as one of the 5 was talent. Talent continues to be a challenge. You know, and I think technology is also a challenge. Sustainability, that's one of those things that I feel like organizations are still working to grow into. I know some organizations have, depending on how you define it, some organizations are working quickly. Some have longer term goals on sustainability. It's definitely something that I think is an efficiency play and can also be an environmental play at the same time. So sustainability is something that I think will just continue to grow. And trade I think is changing. You made the comments, Ben, around friendshoring, nearshoring, onshoring. I think what we will see is that organizations, and part of this is directly, I believe, driven by the pandemic, as you point out, Ben. We saw the gaps in trade, some of the issues. So we got pandemic, we've got trade war, we've got actual wars, we got all these kinds of different things that were coming into play. I think organizations realized, hey, we have concentration risks that we've been ignoring. And what we may end up with is more diversity on a global basis. Doesn't mean globalization goes away. It means that the diversification of it becomes more prevalent. I think that's where we may end up being. And some companies, organizations are going to make conscious decisions that, hey, I'm just not going to have a platform where I'm engaging in trade activity with certain regions or countries. Some organizations may do that. It's one of those things that you talked about, hey, it's kind of contentious, right? Then people have some really strong feelings about that. So I think trade is changing. I don't think globalization goes away by any means. We certainly have a lot more uncertainty around what's going to happen on the capital side. I was just reading on Bloomberg, Goldman Sachs and Morgan Stanley have a divergence in thought around Fed rate cuts. So some of the top banks here in the U.S. are even divergent in terms of what that looks like. So there still remains, I think, some uncertainty around capital. Hopefully organizations were proactive and positioned themselves to have a balance sheet to fit the times of stress. Things are changing. Globalization isn't going away. It's just going to look a little different.
Yeah, I think that point on the trade aspect that you made, Paul, is spot on around diversification. Maybe a few things that companies had perhaps taken for granted before some of those volatility issues that we mentioned at the top kicked in. You know, you've got to diversify if you want resiliency in your supply chain. You need option B, C, D, and E, maybe through to X, Y, and Z at the end, in terms of if you can kind of switch a tap on and switch a tap off as and when you need to respond to different interconnected issues that are happening within your supply chain. So I think that's definitely one of the big trends that we've seen recently.
Yeah, that's a really good point around flexibility. And that means your trade relationships have to be even stronger now than they were before. So it seems like there'll be more emphasis and attention to that.
Well, Ben and Paul, your insights are truly on point. From globalization, let's shift the conversation to credit risk. The International Chamber of Commerce, along with partners Global Credit Data and Boston Consulting Group, has released its 2023 Trade Register report, reaffirming that credit risk in trade, supply chain, and export finance remains stable despite times of ongoing global macroeconomic uncertainty. Paul, with the geopolitical and economic environment likely to become more challenging and access to liquidity and risk mitigation increasingly valued by treasurers, do you foresee trade, supply chain, and export finance products remaining low risk in 2024?
That's a great question, Push. This is really interesting. The timing of this article is really good. We had our local CFA society, we had a representative from JP Morgan come in and talk about investments in supply chain or trade. And, they're quite bullish about it. Their point is that, listen, demand isn't going to just completely dry up and go away. So I think what you need to focus on is diversification and understanding of where investments in the right areas make more sense, whether it's industry sector or region. And so it's one of those more, are you doing security selection? Yeah, I think there's some security selection that's involved in there, but you're also looking at a more macro level as well to help you make decisions. So I think there's still opportunity for good investments in this area. Do I think there'll be challenges coming up over the next 12 months? I think there'll continue to be challenges because of a variety of things. We talked about just a little bit ago around changes in terms of supply chains. And, globalization may be looking different in terms of where you're getting input goods or goods and services, where you're getting them from. Where's that supply come from? Is it onshoring, nearshoring, friendshoring? Some of the, more longer term relationships we've had. President Biden is meeting with Xi Jinping to talk about our differences that we have. And, obviously trade is going to be talked about. I don't know how it's not in those conversations. We're an important component to China. And so, this conversation is obviously going to be really important to them. It's a matter of, I think, looking for the right opportunities. I didn't mention the wars going on. Those also have disruption in supply chains, whether it's grain or fuel or otherwise. There's some challenges there. So I think there's challenges, but there's also opportunities out there. It just won't be perhaps as clear as we've had in the past. So I think 2024 will be a little bit of a mixed bag.
Yeah, the resiliency of the trade finance market that this story notes is really interesting, I think. John Denton, the ICC Secretary General, says in the statement that came out with the report, since the pandemic, we've been waiting to see whether the trade finance market finally shows signs of weakness as it battles the delayed impacts of the pandemic. However, this seems to simply not be the case. So that's good fortune for not just corporates, but obviously banks that are in that space as well. And obviously, while default rates clearly increasing in the volatile world that we've witnessed and described quite a lot on this podcast already today, trade, supply chain and export finance assets are demonstrating resiliency against that backdrop. And so that's something that should be attractive for banks and investors to kind of continue supporting the trade finance asset class, I suppose. So that's really interesting. There's a lot of things in the kind of the economic state of the world this year that have been very surprising, perhaps from an onlooker's point of view, where you're waiting for a certain market or a certain currency or something to drop because all the peripheral data suggests that, well, this is a terrible time to be doing business in. But there's been quite a lot of resiliency in several different markets, which I think is quite reassuring, I suppose, for treasurers, that resiliency is seen on kind of the global scale. So, yeah, I thought this was a fascinating story.
Well, Ben and Paul, you've given our listeners great food for thought. Moving on to the next story, which is the fourth topic for today's discussion. This is about financial institutions scrambling to streamline trade processes ahead of T+1 settlement cycle. The fast approaching switch to a T+1 settlement cycle is intensifying concerns about potential breakdowns caused by firms still relying on manual and inefficient processes for essential middle and back office functions. The U.S. Securities and Exchange Commission has set 28th May 2024 as the date that financial markets will move to next-day settlement on trades. Meeting that deadline will require sell-side and buy-side firms to work together to accelerate trade reconciliation and other parts of the trade life cycle. However, new data from Coalition Greenwich and Acceptor highlights potential risks stemming from the fact that most market participants are still conducting up to 20% of reconciliation offline using systems and processes built in-house. Meanwhile, pockets of firms have even higher percentages. Ben, you collated this story for CTMfile. What do you think are the potential risks or losses that could arise for firms that rely on manual and inefficient processes as they gear up for the new T+1 settlement requirement?
Well, as you said, Push, the deadline is rapidly approaching. It stands at the end of May next year, so time is clearly ticking for financial institutions to get their systems and processes and technology in order. For treasurers, the risk of financial institutions missing this deadline is that it could deny them some of the benefits that T+1 should bring. Shortening the settlement cycle to T+1 can reduce the time and resources required for post-trade operations, such as confirming and reconciling trades, managing collateral, settling transactions. So treasurers could benefit from streamlined processes and perhaps lower operational costs in that world. And with faster settlement, there's also less time for counterparty default risk, which could be quite advantageous for treasurers managing their cash and investments. And faster settlement also reduces other kinds of risk, market risk, credit risk, all those things that can just kind of have an impact on the transactional side. Thinking about investments, a T+1 settlement cycle could provide more flexibility for portfolio management and optimizing investment strategies, all because it's shortening that time between the trading and the settlement. So those are the things that could be in the treasurer's mind when it comes to thinking about the end of May as that deadline for the financial institutions that they deal with. So the risk is that those things might not happen as soon as treasurers might be counting on them. And also another side of things to think about is perhaps treasurers don't have that deadline, but they do need the systems that can handle perhaps faster executed data that's coming to them from their financial counterparties. So that's just another thing to think about on the Treasury digitalization journey. The author of the report from Coalition Greenwich, Audrey Blater, noted that many firms are struggling to streamline their workflows due to a lack of that data standardization. And there's a lot of unstructured data in there, which he lists things like faxes, emails, PDFs, data scrapes from screens. So that's a lot of stuff that isn't conducive to fast settlement, I would suggest. So with that deadline in 6 months, it'll be really interesting to see if the SEC kind of holds its nerve and sticks to that deadline, or if this is another, I think we're quite used to in the regulatory world, seeing deadlines just kick down the road a little bit to make sure that every part of the sector that's impacted by that regulation is able to get over the line with their transition projects.
I think it's important to point out that, we're talking about fixed income instruments here. We're not talking about equities, trade settlement. We've already been trading T+1 on equities for quite some time. But fixed income instruments, in some instances, some settle more than T+3. And some can settle within, T+2. Private transactions, this won't have an impact on private transactions because those are a different animal. So the negotiation and settlement of those types of trades, I think, will continue to follow the normal course. Although I can tell you from experience with an insurance company I worked with, private transactions, trying to get more information visibility from like a security master file standpoint, I think would be super beneficial if someday they're able to have some type of trading aspect for these private transactions. That would be a huge improvement. One of the things I think is really going to be interesting with this, moving to T+1, is price discovery and the impact it has on, to your point, efficiency with portfolio management. This is going to be a really good thing. So, organizations like insurance companies, I have a ton of insurance companies here in Iowa, and they have fixed income portfolios. I think this is going to be a big benefit to them. You always worry about settlement risk, what's going to happen there. And being able to have a quicker settlement, I think will alleviate some of that risk associated with challenges in the market, something that disrupts it, that could have an impact on pricing, could have an impact on settlement, impact to the organization that you're making an investment in. I think this is, a really good move. Obviously, challenges associated with organizations that are still using either home-built systems or even spreadsheets in some instances. They're going to have to make a move quickly if they haven't already started the process to get the right platform in place so that they can manage this more efficiently. Certainly, I anticipate that the potential for hiccups along the way once this goes live is probably going to be real, and there may be some challenges for back offices working on trade settlement to get the trade settled within the appropriate time frame. So perhaps some challenges on the front end. Organizations, if they're not working on this, they should be. I have a hard time believing that organizations aren't focused on this. It's a big deal. I think it's going to be positive writ large. So good job in the article pointing out some of the challenges that organizations are facing.
Finally, Paul and Ben, what is your choice for the biggest or most important story of the past week and why? If I could ask Paul to go first, please.
Yeah, Push. There's a lot of things going on out there. Biden meet with Xi Jinping, Fed coming out and making statements that still are impacting the market around rate hikes. That's still on the table. That's not gone away. So, those are big stories. But the one article that just stands out to me is the Citibank survey article. I just think it's going to be really valuable for Treasury departments to leverage the information and material that's inside here. This article just points out a lot of things that are going to be really valuable to companies. It points out the benefits associated with it, and I think it's going to drive organizations to push towards more support and resources in these areas that are going to be vital for organizations, and it's going to help their bottom line. So I think that's really valuable.
Yeah, I'd echo Paul's comment. Definitely check out that Citi report. It's really full of fascinating insights and information that you can kind of compare your Treasury department against and give you some indications of things that you perhaps might not have been thinking about that you could be thinking about. My top story, I think, just today, as we're recording on Monday, the 13th of November, we've just had a cabinet reshuffle in the Conservative government in the UK as the Prime Minister, Rishi Sunak, kind of scrambles for some credibility after several huge by-election defeats in the past year. So the Home Secretary, Suella Braverman, who's widely nicknamed Cruella after statements such as describing homelessness as a lifestyle choice. She's finally been given the boot and been replaced by James Cleverly, who was the Foreign Secretary. And the new Foreign Secretary, very bizarrely, is former Prime Minister David Cameron. He's back. Now, Cameron, he's not even been a Member of Parliament for over 7 years now. But he will sit in the upper chamber of the British Parliament, the unelected House of Lords. So we're in a really strange situation where the incumbent of one of the great offices of state, the Foreign Secretary, won't be able to be questioned on foreign policy by MPs in the House of Commons. So that's a really strange scenario. So thank goodness the Brits took back control from those unelected bureaucrats in Brussels. Unelected bureaucrats in London is the new hot trend.
We've come to the end of this podcast episode. Paul and Ben, your insights have added a valuable layer to today's podcast discussion. So thank you so very much for your time and participation. We would also like to express our deep gratitude to our CTMfile audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.